So yesterday, the 30-year bond market auction, which basically means that the federal government was borrowing more money, glitched like Mitch McConnell at a press conference. Something went wrong, and not like not as many people bought the bonds as was expected. So when that happened, people then looked to this previous report from the Treasury Borrowing Advisory Committee and found out that in late October, they had actually warned Secretary Yellen that deep down into this report, demand for U.S. Treasuries may have softened among several traditional buyers. And of course, this matters to us in the real estate business and the mortgage business because more or less the bond market dictates mortgage rates. And of course, that has a huge impact upon the real estate market. So when yesterday happened and the 30-year bond market glitched, it also glitched the 10-year bond market and yields spiked, which consequently meant that mortgage rates are also going to go up. Remember, the 10-year is about 300 points lower than you add 300 points to the 10-year and get your 30-year fixed, roughly speaking, although now it's like about 290. So yesterday, when Robert Burgess from Bloomberg said, did the 30-year bond market just glitch? He was talking about the fact that the 30-year spiked after a sale of $24 billion in bonds, received far less demand from investors than the government is used to, according to Holger Zeppelschwitz, who's a German bond trader. Primary dealers, in other words, the big banks, are obligated to finance whatever portion of the Treasury auction isn't purchased. So for the pleasure of facilitating this transaction, if nobody's out there to buy Treasury bonds, then the dealers, the people that make the market, the big banks here in the United States, they have to buy what doesn't get bought. And yesterday, they bought 25% of what didn't get bought. And they usually buy more like 12%. So they had to double the amount of their purchasing, which, to me, simplistic Jack, no economics degree here. But the big banks, who are the big banks really? They're really kind of us in a way, right? And so when we're buying our own debt, that just screams to me to be slightly a little even more exponentially inflationary. But, who am I? What do I know? I'm just a little old real estate broker here in Massachusetts who figured out how to stream on YouTube. So this all fed, it is a perfect story for Zero Hedge. If you know the kind of the flavor of the articles that they get at Zero Hedge. Stocks tumble, yields surge after catastrophic 30-year auction stops with the biggest tail on record as foreign demand craters. So what happened? The story up till now is that because of the escalating national debt, which I brought you this chart from Axios the other day. Look at the projection for the share of the U.S. debt to GDP over the next 20 years or whatever this is, 25 years. It's exponential, going up to 180% of GDP out in 2050, which I know doesn't sound, it's not around the corner, but it's not that far, especially when you're starting to buy 30-year bonds. So that was really bad news for what interest rates might be on the near term and the long term yesterday, when the market basically regained everything that it had lost, or if you want to think about it, the inverse. Remember how we had that slide down in mortgage rates over the last week or so, where mortgage rates dropped by like 0.6%. It went from basically 8% down to 7.4 in like a week. Well, yesterday, it basically regained almost all of that. It retraced almost all of that, and mortgage rates are now back up to over 7.5. They're 7.55, according to Mortgage News Daily. So it gave all that back. And I was looking like, like I told you, I'm not buying this short-term dip in rates. I think rates are going to go back to 8. I've been telling you that. That's how I feel about mortgage rates because of the debt situation, the Treasury situation, and the inability of the Fed to counter what the Treasury is doing. So all of that happened, and it was pretty scary for the future of U.S. borrowing. And also, we had Powell yesterday speak. He once again got interrupted by climate nuts in the beginning of his speech, and somebody dropped the F-bomb during the whole it was pretty funny. Anyways, now this morning, according to the Wall Street Journal, we're being told, and I don't want this channel to become into some type of financial conspiracy channel, but now we're being told by the Wall Street Journal and the Guardian that no, it wasn't a soft demand that we were officially warned about in the October 31st Treasury press release. It wasn't soft demand. Oh, no, it was just a ransomware attack at a bank in China. Yeah, ransomware attack at a bank in China. Ransomware attack on China's biggest bank disrupts Treasury market. American arm of ICBC is latest victim of hackers, and it is investigating. And it's this ransomware attack that disrupted trades in the U.S. Treasury market on Thursday. So the whole thing about not enough people who want to buy our bonds, no. It was just a ransomware attack. It was just a ransomware attack. So if you read this story in The Guardian, produced by Reuters, is that how you say that? And you go way down to the bottom of the story, you actually find out that the headline itself is BS. Some market participants said trades going through the bank were not settled because of the attack and it affected market liquidity. The last sentence of the article refutes the headline of the article. It was not clear whether this contributed to the weak outcome of the 30-year Treasury auction on Thursday. You see, when you have a Treasury auction, basically the government going to borrow money, it's just like Lending Tree. Remember the old tagline from Lending Tree, when banks compete, you win? And right, if you have a lot of banks who want to lend you the money, they are going to compete and offer you a lower rate, and therefore you're going to get a lower rate for your car loan or your mortgage or whatever it happens to be. But if you only have a handful of banks who want to lend you money, then there's not as much competition for your loan, which they consider an asset, and therefore you're going to pay a higher rate for that car loan or whatever it happens to be. And that's exactly what happened to the 30-year Treasury market yesterday. And it's incredibly embarrassing and very dangerous for the U.S. economy and mortgage rates if nobody wants to buy our bonds anymore, or not enough people want to buy our bonds anymore. I don't want to say nobody, but not as many. Yeah, that's probably the best way to describe it. That demand has softened. If demand has actually softened, that is really bad news for us. That's really bad news for us. So out of the blue, you get this article explaining that, no, it wasn't a softening of demand. It was this ransomware attack. Don't you worry. Don't you worry, it's a ransomware attack, which gets Zero Hedge, and they're kind of conspiratorial, just a teeny bit, asking the right question. So the U.S. Treasury market was allegedly crippled by a hack of China's largest bank. They're not buying it either. And if that is true, isn't the bigger story here that a Chinese bank can paralyze the $75 trillion U.S. bond market? And that is the right question to ask, right? This simple explanation story that it was a ransomware attack is they're not asking the right question. If a ransomware attack can cripple the bond market, whoa, that's almost that's as big a story as soft demand for bonds, right? That's as big as a story as soft demand for bonds. So we're going to have to follow this as time goes on. As I said yesterday, mortgage rates jump back up 0.14 yesterday, back to 7.55. Now, since the Wall Street Journal article has come out this morning, I was noticing the price action on the 30-year Treasury. Here it is here. Basically, it retraced the dropping of this Wall Street Journal story, basically retraced most of the glitch from yesterday. But I'm just not buying it. I am not buying it. I don't want to be a conspiracy theorist here, but I am not buying it. The 10-year Treasury is now just under 4.6. It was 4.6 when I came in this morning, and it's lost a little bit. So there is definitely something strange going on with our bond market. We got to have to keep a real close eye on that. Now, for those of you who remember 2008 and all the mortgage shenanigans that went on, I got a couple of stories here that are concerning to me. By the way, I love your questions. If you want to dive in and throw up a question there, that'd be fine. Some of you remember the crazy mortgages that were available leading up to the financial disaster of 2008. One of my favorite crazy mortgages was the stated income loan, which it was like a one-page application for a mortgage, and you just wrote down on the page what you made. So if you were self-employed or owned a business or something like that, and you wanted to say that you made $225,000, all you had to do is write in the number and then sign the thing at the bottom of the page, and that was it. Stated income. They took your word for it. Even if you only made $63,000, they weren't going to double check, and they were just kind of going on your word. So I think we're starting to see some stories of potential mortgage fraud that's going on now, and they concern me. So let's take a look at this Airbnb situation out of Toronto. Here we go.
So this is why rent in Toronto sucks ass. This is like 100 Airbnb lock boxes at an apartment complex.
So
this is why rent in Toronto.
All right, we get the idea. So my concern for that apartment complex, obviously, if Airbnb business declines by 10, 15, 20%, how many of those Airbnb owners are no longer going to be able to make their payment on the unit? And what does that mean for the entire apartment complex? I also have slight skepticism about that video itself, because if you're renting at that complex, how do you find your key if all the lockboxes look the same? I don't know, maybe they're numbered or something. But so slightly suspicious about the video, but you get the idea. In places where there's a high concentration of Airbnb, if we see Airbnb go down, as it has slid, definitely, what does that mean for some apartment complex and the loan that backs that apartment complex? Mid-sized banks, I'm looking at you, for potential default for those apartment complexes. Following up in the same vein as that, occupancy fraud. This story is from last month, but still very, very on point with the whole Airbnb situation. Occupancy fraud may be the next risk for the mortgage industry. A conversation with Bridget Berg from Core Logic. One trend that Core Logic has spotted in the property market is an increase in suspected occupancy fraud. Jack, what's occupancy fraud? Occupancy fraud is saying that you are going to live there, but you're not going to live there. Because as many of you know, if you get a mortgage for your primary residence, you would get better terms typically than if you were getting it for your investment property. Because, the thinking is, if it's your primary residence, you're going to fight like hell to pay that mortgage because you need someplace to live, rather than an investment property, rather than an Airbnb. An Airbnb, you might end up saying, strategically, F it, right? You're right. Just like, I'm just going to strategically default on that loan. Here's the keys. Good luck, bank. And because you don't live there, right? And so when times get tough, you just might be like, screw it. And mortgage companies know that. And obviously, they tend to charge you more money for an investment. But if you lie and say that you actually do live there, there is the rub. I remember a long time ago when I was just a young whippersnapper, I was thinking about buying a condo on Beacon Hill when it was studio condo, walk through condo. So it was a front to back condo, but it was a studio. They were going for like $115,000, $118,000. No, I know. Don't get me started. I know I should have bought it. And what an idiot. And this is probably 1992-ish, 93. And the one, because I only had my state house salary, I was making like $25,000 a year or whatever. I qualified for this somehow like program, but I had to promise I was going to live there for 10 years. And, you know, 23-year-old Jack couldn't really conceive of living someplace for 10 years. I had never lived anywhere for 10 years. And so I was like, oh, I can't do that. And what if they track me down and they find out, 7 years from now, I'm not living there? So like I would have lived there for several years, but I don't know. I couldn't commit myself to 10. So being honest, I didn't do the loan, and what an idiot, I didn't buy the condo. Looking back, maybe I should have went 67 and a 65 and bought the thing. I don't know. But at 118,000, man, I wish I could go back in time. But I did the right thing, and I didn't lie. But apparently, I know this comes as a shock to your confidence in your fellow human. Apparently, there are some people that lie about how they're going to be using the property. Typically occurs when someone identifies an investment property as a primary residence to obtain more affordable rates. So it just has a 2008 feel to it. It just does. Like, that doesn't make me feel too good. Freddie Mac halts deal making in Meridian Capital. I think there's a lot more to this story, and we're not going to cover this in depth right here, but Freddie Mac, the big lender, has put Meridian Capital under microscope after a single loan brokered on behalf of the government-sponsored entity was called into question. I just think that there's a lot more to this. So Meridian Capital is a pretty big lender, and to have Freddie Mac just say, no, we're not going to do business with you right now, you're suspended for one loan, that sounds like a tip of the iceberg story to me, as far as I'm concerned. And I wonder how many other companies are also kind of like going 67 and a 65, right? So it reminds me of school. When you first go to school year starts, the principal comes in and says, these are the rules, and everyone for the first week or so obeys the rules. And then in the second week of school, like, there becomes an understanding of which rules are more important than others and which ones you can break and which ones the teachers aren't going to enforce, right? And everything's fine. And, things come to an equilibrium. There's a unofficial understanding of what the rules are and what you can get away with, until one student, one knucklehead, breaks the rule and then does something egregious and ruins it for everybody. Then the principal comes back and says, slaps that kid upside, sends him to don't hit your kid, sends them to detention. And then the rules are back in place and strict for everyone. That story reminds me of that. And I think you're familiar with that dynamic. So the other day we talked about Florida and how we were looking at some numbers, and the numbers in Florida were interesting. It was an anomaly where they had an increase in listings and consequently also an increase in price. And it was one of the fewest places in the country where listings went up and price went up. And we were talking about this on the live stream, and one of you from Florida interjected, and I speculated that this was probably due to interstate migration. And we got a confirmation on that yesterday from the Tax Foundation. State population changes attributable to interstate migration in 2020, 2021. So this is a chart. It's color-coded. It's pretty easy to see. Net gain or loss of residents from interstate migration as a share of the 2020 population. So this is probably a story we're already familiar with, but it confirms what we suspected. And I think there's been other studies. Idaho, to my surprise, number one. A lot of people from California moving to Idaho. Montana, number two. I think the Yellowstone, right, show, probably helping them gain population. There could be also a lot of wealthy people moving there as a tax haven or whatnot. Florida, number four. South Carolina, number three. The Carolinas did very well. North Carolina was 9. But Florida, number 4. And certainly they have a lot of population, so it takes a lot to move the number, as opposed to like Montana. It probably doesn't really take a lot to move the number proportionally. New York was the number 1 state that people moved away from. California, the number 2 state people moved away from. Then also there was Illinois and Massachusetts. Louisiana also. A lot of people moved from Louisiana. Yeah, so people are moving from high tax states to free state of Florida, South Carolina, which I'm guessing is also somewhat lower taxes. Got to be lower taxes than New York. Everything's lower taxes than in New York. I don't know why people move from North Dakota. That could also be a situation where there's just so few people that live in North Dakota to begin with that they moved, right? But the trend is probably because of the taxes, right? Probably of the taxes and freedom, the application of freedom. So yesterday we talked about the speculation that the chief legal counsel at NAR might be out. What's her name? Johnson, I think. And I was like, she should probably be fired. I mean, you just lost a case that is potentially going to cost your organization $5.3 billion. You should probably just quit out of your own self-respect. But the new CEO should fire you just to prove that she's in charge, that the new CEO is actually in charge. And so I was wrong about that. Apparently, the legal counsel, she's still there. Maybe she knows too much and they're afraid to fire her. I don't know. But they did decide to put 2 in the hat for the human resources director. So it wasn't that long ago that we had a particular elected candidate, public figure across the country. I know you all know his name, who labeled Washington, D.C. and permanent Washington as the swamp. And this woman that got fired basically from the National Association of Realtors effectively represents the swamp of permanent National Association of Realtor employees and is effectively the figurehead for the problem. She's worked at NAR for 38 years. 38 years. And what is NAR? NAR is basically a miniature government. A miniature government, isn't it? Really, that's what it is. That's a good way to think about it. She represents the swamp. And how many other people are like her throughout the associations across the country who are making pretty good salary, way more than your average member of the association? She made, this woman here, Donna Gland, longtime NAR HR chief, set to retire after 38 years. She was making $565,000 in 2021. And she pulled in $2.5 million in compensation from 2017 to 2021. What is that, 4 or 5? She's getting $500,000 plus a year. That is like, how much does your average agent make? Like 60 or something like that? She's making bank, and she's been there since 1985. 1985. Oh my God. I mean, that is a really long time. It's staggering. She's the swamp. And again, imagine how many people are actually making salary from associations all over the country that it's a good job at a good wage, as Mike Dukakis used to say. By the way, I did not know that NAR had its own like miniature skyscraper in downtown Chicago, as you can see in this picture. So I was like, what is that building? It's actually called the Realtor Building, and it looks like it's a good 15 stories tall or whatever. It's got this kind of round thing at the top. I imagine that's where the executives are. And it's right on Michigan Avenue, right on the Magnificent Mile, right next to the Wrigley Building. I mean, this is prime real estate. And this, if you're a member, I've walked down this street. Maybe you have too in your visits to Chicago. This is prime real estate, and that's where your dues are going. Now, it's probably a good investment to own a building in downtown Chicago. And again, we don't know if they actually own it or leasing it. But if your average member is making 50, 60 grand a year, maybe you should be in a nondescript industrial park on the outskirts of the city rather than having an office tower on Michigan Avenue. Yeah, I'm just saying, what are the optics of that? What are the optics? Who are you? Right? How are you spending your members' money? How are you spending members' money? You're spending it on cushy $500,000 HR executives, and you're spending it on luxurious office space and so much other waste. All right. Did we get any comments? We didn't get any comments. I'm shocked. What happened to the comments? We had so many comments yesterday. All right. So that wraps the show for today. We'll see you Monday at 8:30. Go make some money. Have a great day. Bye-bye.